Welcome to the Time and Market Deep Dive. Usually we think building wealth means buying the massive, um, gleaming tech monopolies of the world.
Oh, absolutely. Everyone wants the mega caps.
Right. You buy a mega cap stock, it rockets up, it makes the evening news, and, well, you feel like an absolute genius.
Yeah, it's a great feeling.
It is. But what if I told you the real generational wealth in 2026 is actually being built in the gritty, largely ignored strip malls of the stock market?
It's a really fascinating shift. And I mean, it's happening almost entirely under the radar of the mainstream financial media right now.
Totally invisible to most people.
Exactly. Though, before we get too deep into the mechanics of all that, we do need to put out our standard reminder.
Yes, the mandatory disclaimer.
Right. This deep dive is strictly for entertainment purposes.
Yeah,
You should, always seek professional advice before making any actual investment decisions.
absolutely essential to keep in mind. So let's get into our mission for this deep dive. We are actively decoding a massive rotation happening right now in 2026.
And it is massive.
It really is. Small cap value stocks are quietly but violently crushing growth stocks, like by up to 9 points in some recent measures.
Which is just staggering.
Yeah. So to understand why this is happening, we are conducting a full analysis on one of the biggest tools in the space, the Vanguard Small Cap Value ETF, ticker symbol VBR.
Right. VBR.
They want to see exactly how it captures this premium. And, this couldn't be more relevant for you, the listener, today.
Definitely. Especially if you've been riding that wave.
Exactly. Like if you are listening to this and your portfolio has been happily riding that huge wave of the Magnificent Seven large cap tech stocks for the last few years, you might be looking at your asset allocation right now and feeling, well, completely overexposed.
A lot of people are feeling that right now.
Yeah, you're probably wondering where's the next cycle of growth actually going to come from?
Right.
So this deep dive is really about finding out if small cap value is that missing puzzle piece for your portfolio in 2026.
And to really grasp what VBR is doing today, we have to start by understanding the fundamental battle at play here.
Which is?
It's small cap versus large cap. I mean, for a lot of people, the immediate question is why an investor should even bother with smaller, less stable companies.
Right, especially when the mega caps have all the structural advantages.
Exactly. They have endless cash piles and all the media attention.
Oh, let me stop you there because that is exactly what I'm wondering. Like, why leave the safety of a $2 trillion company that practically prints money?
So you really have to go back to 1992 to understand that.
Okay, 1992.
Yeah. Two academics, Eugene Fama and Kenneth French, they essentially broke the stock market's code by proving what they call the size factor.
The size factor.
Right. Before them, everyone just looked at general market risk. But Fama and French, they proved that smaller, cheaper companies carry distinct risks that actually reward the investor with a significant premium over time. And the historical data is, well, it's just staggering. If you look at the data from 1928 all the way to 2016, small cap value stocks delivered a 13.5% compound annual growth rate,
Wait, 13.5% compared to what?
compared to 9.7% for the S&P 500 over the exact same period.
Oh, wow.
Yeah. Academics call this the small minus big return spread. And it has been positive about 2/3 of the time since 1927.
Okay, I want to pause on those numbers for a second because 13.5% versus 9.7%, it might not sound like a galaxy of difference to someone just, scanning a spreadsheet.
Right. It's just a few percentage points.
Yeah, but over decades, the compound interest on a near 4% annual gap is, literally the difference between a standard, comfortable retirement and buying a private island.
It's a massive difference.
But okay, let's unpack this. I have to push back here a little bit.
Sure.
Is this small cap premium just a reward for enduring a miserable, bumpy ride?
How so?
Well, if these companies are younger, less researched, and, way more sensitive to economic downturns, it sounds like driving a sports car with absolutely no shock absorbers.
Ooh, I like that analogy.
Right. Like, sure, you might get to the finish line faster, but you are going to feel every single pothole along the way.
Oh, absolutely. The volatility is undeniably steeper, so you definitely feel the potholes.
Yeah.
And the liquidity risks are higher too, meaning it could be harder to buy and sell these stocks without moving the price.
Right, because the trading volume is lower?
Exactly. But the why behind the premium, it isn't just about hazard pay for investors enduring a rough ride. There are deep structural reasons these companies can surge the way they do.
Okay, so what kind of structural reasons?
Well, think about agility. Smaller companies can adapt incredibly fast.
Oh, sure. Less red tape.
Right. When the economy starts to recover from a downturn, they can pivot their business models and scale their revenues much faster than a massive corporate bureaucracy.
That makes sense.
Furthermore, they are the prime targets for mergers and acquisitions.
Oh, right. The M&A activity.
Yeah, when a massive tech or industrial giant wants to innovate quickly or, just buy market share, they simply acquire small caps.
They just buy them outright.
And they usually do this at a hefty premium, which instantly rewards the small cap investor.
Nice.
And crucially, smaller companies benefit disproportionately when interest rates drop.
Why is that?
They often carry more debt relative to their size, so falling rates significantly lower their financing costs. That frees up capital to expand.
Okay, the historical theory is sound, and the mechanics definitely make sense. But history is, well, it's just history.
True.
Knowing what worked in the 1920s or the 1990s is great, but we aren't investing in the past.
No, we aren't.
So we transition now to the exact market conditions of 2026. Is taking on that no shock absorbers risk actually worth it right now?
This is where it gets highly specific to our current moment. The tape in 2026 is telling a very clear story. Value is definitively separating from growth.
How extreme is it?
Well, we've reached a point where large-cap tech concentration has become genuinely alarming. The top 10 U.S. stocks are now claiming over a third of the entire market.
A third. That's insane.
Yeah, just a decade ago, that number was 18%.
Wow. So what does this all mean for 2026? Are investors just fatigued by looking at incredibly expensive mega caps? Or is there an actual structural shift happening beneath the surface?
What's fascinating here is that it's entirely driven by valuations.
Okay.
It isn't just an emotional escape from large caps. It's a cold, calculated shift of capital to where valuations are demonstrably cheaper.
Right.
Think about the PE ratio. We hear that term a lot. But fundamentally, the price-to-earnings ratio is just the price you are willing to pay today for $1 of a company's earnings.
Right. It's the price tag.
Exactly. And the difference in that price tag between fast-growing large companies and smaller value companies has been widening steadily since roughly 2018.
Meaning investors have been willing to pay wildly inflated prices for large tech earnings while basically ignoring the earnings of smaller companies.
Precisely. And when you buy stocks at lower multiples, you are gaining immense resilience during periods of market stress.
You have that downside protection.
You do. But more importantly, you have room for the market to re-rate those companies higher once they start getting attention again.
The slingshot effect.
Exactly. When a cheap stock suddenly proves it has solid earnings, investors rush in and they're willing to pay more for those earnings. That creates a massive surge in the stock price.
And we are seeing that right now.
We absolutely are.
Yeah.
Through early June of 2026, the Russell 2000 returned roughly 15% year-to-date. Small cap value is actively crushing growth.
So if the data says small cap value is a coiled spring right now, the immediate question for you, the listener, is how do you actually buy it?
Right, you need a vehicle.
Yeah, you can't just buy a concept or a theory, you need a ticker. And that brings us back to Vanguard's small cap value ETF, ticker VBR.
Let's dive into it.
Now, people might be waiting for us to do, a full 10-year discounted cash flow analysis here.
Oh, right, with a 9% growth expectation and a specific free cash flow base.
Exactly, like using a 10% discount rate and a 2.5% terminal growth rate to find a final calculated intrinsic value.
Yeah, but we really need to clarify something for the listener right up front.
What's that?
While that kind of specific DCF or intrinsic value projection is great for a single company, it just isn't standard practice for an ETF composed of almost 840 stocks.
Right. That would be a nightmare to calculate accurately for the whole basket.
It really would be. So instead of giving a strict buy, hold, or sell verdict based on a calculated intrinsic value, we evaluate the ETF based on its index methodology and its macro multiples.
That makes perfect sense, because a lot of investors make the mistake of evaluating an ETF just by looking at its top 10 holdings, or worse, just glancing at the trailing one-year return and hitting buy.
Which is a terrible idea.
Truly, we want to look at the actual engine of this fund. So as of June 10th, 2026, VBR's market price is sitting right around $236.13.
And we need to look closely at those macro multiples we just discussed, because that tells you the fundamental value story of the aggregate basket of stocks inside VBR.
Okay, what are the numbers?
Currently, the ETF boasts a highly attractive PE ratio of 17.8.
17.8. Yeah.
And it has a price-to-book ratio of just 2.0.
Let's break that second one down because price to book gets thrown around a lot.
Yeah.
Basically, price to book simply means looking at everything a company actually owns, like its factories, its cash, its inventory, then subtracting everything it owes and seeing how much the stock market is charging you for that baseline underlying value.
Right.
So a 2.0 multiple means you are paying a very reasonable premium for actual tangible assets.
Exactly. And the performance of that basket reflects that solid foundation.
Let's hear it.
Looking at the recent data, VBR delivered a very strong 9.09% return in 2025.
Very solid.
But 2026 is where the accelerator really got pushed to the floor. It hit over 11.5% year-to-date by June.
And what's wild is what's actually inside it.
Yeah.
Yeah, it's holding a massive basket of 839 stocks. And the top holdings are companies you probably don't think of as typical household names.
Like who?
Well, places like Jabil, Flex Ltd, NRG Energy, and Atmos Energy.
Which is the exact definition of value.
How so?
Well, Jabil and Flex are essentially the unglamorous, behind-the-scenes supply chain and manufacturing backbone for much larger tech companies.
Right, the stuff that makes the tech actually work.
Exactly. And NRG and Atmos are energy infrastructure. They aren't flashy. They don't have, celebrity CEOs on magazine covers, but they generate tremendous steady cash flow.
But with 839 companies, how are they actually chosen? I assume there isn't just a guy at Vanguard sitting in a room pointing at companies and saying, yeah, that one looks cheap.
No, not at all. VBR tracks a specific index, the CRSP U.S. Small Cap Value Index.
See it?
Yeah, it stands for the Center for Research and Security Prices. They don't guess. They use a rigorous multi-factor model to calculate an average rank score for each company.
And what goes into that score? Because, value can mean a lot of things.
It's a composite of several metrics. They look at book to price, dividend to price, and sales to price. But crucially, they compare future earnings to price against historical earnings to price.
Wait, why do both? If historical earnings were great, isn't that enough?
That is exactly how you fall into a value trap.
Oh, interesting.
Yeah. Imagine a company that made a fortune selling DVDs 10 years ago.
Okay.
Their historical earnings look amazing, and their stock price is currently in the gutter. So their historical metrics scream value.
Right.
But if you look at their future earnings projections, well, they're going to zero. Comparing future projections against historical data helps the index identify true value companies rather than just dying businesses.
That makes total sense. Now, here is a mechanical issue that I find genuinely fascinating. Companies are not static. A value stock can have a massive growth spurt and suddenly become a growth stock. If a passive index is constantly buying and selling these 800 companies every single time they cross some arbitrary mathematical line, the trading fees alone would destroy the ETF's returns.
You're touching on turnover, which is the absolute enemy of a passive low-cost ETF. High turnover means high costs and high taxes.
So CRSP uses this genius rule called packeting to solve this. Here's where it gets really interesting.
Yeah, explain the packeting.
When a stock starts to drift, say it's moving from value over to growth, CRSP doesn't just panic and sell the whole position. They established a buffer zone.
A buffer zone, right?
Yeah. When the stock crosses the threshold, they only move 50% of the holding to the new index.
And the remaining 50% stays right where it is until the next quarter.
Exactly.
If the stock continued to drift further into growth territory, they'll eventually move the rest.
It's like dipping a toe in the pool before doing a cannonball. Or, like moving to a new city for a job, but keeping the lease on your old apartment for 6 months just in case you hate the new role.
That's a great way to think about it.
You're hedging your bets so you don't waste thousands of dollars moving all your furniture back and forth if you change your mind.
Exactly.
This packeting rule prevents the ETF from constantly whipsawing, buying and selling the exact same marginal stocks quarter after quarter just because their price fluctuates a few pennies.
Right.
And because of this, VBR keeps its turnover incredibly low. It's around 24.9% annually.
But, if we step back and look at the whole board, that low turnover and very broad methodology comes with a specific, undeniable trade-off.
Okay, what's the catch?
Well, VBR is a phenomenal low-cost tool. Vanguard recently lowered the expense ratio to an unbelievably cheap 0.05%.
Which is practically free.
It is. However, our sources reveal something striking. Even with an 11.5% year-to-date return, VBR actually lagged behind some of its direct active peers in 2026.
Hold on, an 11.5% return in half a year is fantastic.
Yeah.
How is that lagging?
Because in this specific market environment, it didn't win the gold medal.
Okay.
We have to compare VBR's passive broad net to its active competitors, specifically AVUV and IJS.
Let's hear the numbers.
Let's look at AVUV, the Avantis U.S. Small Cap Value ETF. It returned a massive 18% year-to-date.
Wow. Okay, 18% versus 11.5%. To put that in actual dollars for you listening, if you put $50,000 into both at the start of the year, VBR gives you a $5,700 gain.
Right.
But AVUV gives you a $9,000 gain. That gap literally pays for a family vacation.
It really does.
So why is the gap so massive?
Well, AVUV crushed the benchmarks because of how it screens. Now, it charges more for the privilege. It has an expense ratio of 0.25%, which is 5 times higher than VBR. But AVUV is an actively managed quantitative ETF. The Avantis team doesn't just settle for broadly cheap stocks. They actively screen for deep value combined with high profitability and stable cash generation.
And then there's the middle option, right? IJS.
Yes, the iShares S&P Small Cap 600 Value ETF.
Right. That one returned 15% year to date. It charges 0.18%, so it sits right between the two on fees.
Exactly.
And it tracks an S&P index that actually requires companies to demonstrate consecutive quarters of profitability before they are even allowed into the index.
And all of this raises the critical concept of factor purity. If we connect this to the bigger picture, why did VBR lag behind the others?
Right. Why did it?
It comes down to that factor purity. VBR's screen is, relatively speaking, very loose.
Loose in what way?
Because it tracks that broad CRSP index. It includes a much wider range of names, almost 840 of them. And crucially, it has a significantly weaker profitability filter compared to AVUV or IJS.
Meaning it dilutes the specific trait you're trying to target?
Exactly. It's like trying to make a really strong cup of coffee and just adding more and more water to the pot. It dilutes the factor signal.
Oh, that makes sense.
So in a year like 2026, where the specific traits of value and profitability are paying off massively in the market, a looser screen essentially leaves money on the table. AVUV and IJS screened much harder for profitability, keeping their factor purity high, and they were rewarded for it.
I love that coffee analogy, but think of it like this too. VBR is like fishing with a massive, very cheap net.
Okay.
You just throw it out into the ocean and drag the floor. You are going to catch a lot of fish, absolutely.
Right.
But you're inevitably going to haul in some old boots, rusty hubcaps, and seaweed too.
Yeah, those being the unprofitable companies that drag down the average return.
Exactly. Now, AVUV, on the other hand, is like hiring an expensive elite fishing guide who takes you straight to the exact reef where the fattest tuna are swimming.
Right.
You pay more, but you eat better. You are going to pay a much higher premium for the service, but you eat a lot better at the end of the day.
That is a perfect way to visualize it. And I think it leads us directly to the final verdict.
Which is?
How should a listener actually choose between these tools for their own portfolio?
Yeah.
You can't just chase whoever had the best return in one 6-month window.
No, definitely not.
It comes down to balancing costs, your personal convictions about factor investing, and above all, taxes.
Let's address costs first, because high fees compound over time just like returns do.
They absolutely do.
Over 20 years, assuming a $10,000 initial investment, AVUV's higher fee is going to cost you about $360 more than VBR.
Right.
So if you are a die-hard cost cutter who refuses to pay active management fees, VBR is undeniable at 0.05%.
But taxes might actually be the silent killer here, and really the biggest deciding factor.
Oh, for sure.
VBR has incredible tax efficiency. Remember that packeting rule we talked about earlier?
Yeah.
The moving to a new city analogy?
Yeah, keeping the lease.
Right. Because VBR turns its portfolio over so slowly,
Yeah.
it generates very minimal capital gains distributions. This makes it an absolutely perfect holding for a standard taxable brokerage account.
Because, in a mutual fund or an ETF, if the fund managers sell a stock for a profit internally, they pass those capital gains down to you, the shareholder.
Exactly.
So you can get hit with an unexpected tax bill in April, even if you didn't sell a single share of your own stock.
And that is the huge risk with AVUV. It is actively managed. They're constantly tweaking the portfolio, buying and selling to aggressively hunt down those highly profitable, deep value names to maintain that factor purity.
Right.
Their turnover rate is consistently up around 50 to 60%.
So that elite fishing guide is constantly moving the boat.
And every single time they move the boat, they might trigger a taxable event.
Ouch.
Yeah. If you hold AVUV in a regular taxable account, the tax drag from those distributions could easily eat up that extra performance they generated for you.
That makes total sense.
Therefore, AVUV is much better suited for a tax-advantaged account, like an IRA or a 401k, where you are completely shielded from those annual capital gains taxes.
So if I'm tracking this, the final verdict is really about intelligent asset placement.
Precisely.
Treat VBR as your permanent, low-maintenance, ultra-low-cost portfolio building block for passive allocation. It gives you broad passive exposure to the small-cap value premium, and it sits beautifully and safely in a standard taxable account.
Right.
But if you have the space inside an IRA and you want to make an aggressive, tactical bet to squeeze every single drop out of the small-cap value factor, AVUV is the definitive winner for 2026.
It is a phenomenal surgical tool if placed in the correct account.
As we wrap this up, going through these sources really brings into focus how wealth is actually built over a lifetime.
It really does.
The Magnificent Seven might make for fantastic cocktail party chatter. I mean, everyone loves talking about the newest AI chips and the latest smartphones. But real, quiet, generational wealth is often built in the less glamorous, smaller, cheaper corners of the market that the evening news completely ignores.
And as you look toward those smaller corners of your own portfolio, I want to leave you with one final structural thought to ponder.
What's that?
Well, we talk endlessly about small caps, but the definition of what actually constitutes a small company is a constantly moving target.
How so?
The index breakpoints shift to reflect overall market valuations. To give you some stark context, the cutoff point to be considered a small cap stock back in 2021 was over $5.2 billion.
Wait, a $5 billion valuation is considered a small business?
By the index's strict definition, yes.
Wow.
That cutoff is more than 20 times higher than it was when these original indexes were first launched in 1984.
That is wild.
So as you look at your portfolio and try to capture this historical small cap premium we've been discussing, ask yourself something. Are you actually buying true small businesses anymore? Or are you just buying yesterday's mid caps with a convenient small cap label slapped onto them?
Oh, that is a fantastic, slightly terrifying question. It really makes you wonder if that volatile sports car we talked about earlier hasn't quietly turned into a heavy minivan while we weren't looking.
Right.
Like you might still feel the potholes on the road, but you definitely aren't quite as low to the ground as you used to be. Well, that is plenty to chew on. That's all for today's deep dive. Keep your eyes on the road, and we'll catch you next time.